Good afternoon. In this afternoon, I'll talk to you about one concept that never been used in funds, in public funds, in the closed fund. So this concept could be an interesting concept. So I'll talk now about those funds and this new principle. So I'll give you a brief about the main idea and a brief about me, the real life problem, and how we resolve that problem, developing that product and maintain it. Funds, their policies and distribution to support companies or group of companies in a coherent collaboration. So when you have a group of companies around the world, subsidiaries, whatever those companies, in one portfolio, like a large number of small businesses collaborating together, a way of supporting the policies and distribution. I'm Muhammad. I have a Bachelor of Engineering in Microcomputer Systems Engineering, a master degree in Computer Science, 2014. I worked from 2010 until now in many government job and many companies. I created startups and fund them. Also develop tools for continuous integration. I create MVP and make the plan for their development and maintenance. So all available funds, their unit price is variable and the number of units either fixed or variable. We have those funds types, many of them: mutual, asset allocation, income, governmental, global, hybrid, income, commodities, investment, equity, growth, ETFs, sector, commodity, interval, emergency, bond, index, specialized, fiduciary, target date, stock, pension, gilt. All of those types, the unit price, the price of the share or unit is variable, while the number of units or the number of shares is fixed. Or variable. It is fixed in the ETF, and it can be variable when you increase the market cap or you increase the principal, so the number of shares increase. So when we talk about earning per share and define it, a policy that considers the end of company each year and the case that the division is not possible, like dividing 3 cents on 5 people. The policy is that the company ended each year. We consider that this fund is closed, ended, this company ended every fiscal year, and we need to distribute the remaining asset to shareholders. So imagine that we have 3 cents and the shareholders are 5. You can give a cent to 3 people and 2 people will not have their share, because you can't divide a cent on 2 people. You can't give it to you can't give it's not divisible because it is the smallest unit of the currency. So a company has, this is the example, a company has $1 billion. The example, a company has 1 billion shares and income is 11 million. The EPS is 1 cent, and a total dividend is 1 million, which is a thousandth per share. The thousands cannot be deposited to each share holder account if the shareholder own less than 10 shares. If I own 10 shares, I'll get 1 cent. If I own a multiple of 10 shares, like I own 10,000, I'll get that cent, that thousandth of cent. If I don't own 10 shares, like I own 10,005 shares, I will not get that 1 cent. Invest to a target amount is not available. You invest to a target date, not a target amount. So investing to a target amount to reach that amount. And I'm not considering my target is a specific date. My target is reaching that amount. I'm investing 10 US dollars. I want it to be $1,000. Tell me how many days, how many months, how many years shall I wait until it comes $1,000? So all available investment firms doesn't provide a multiple products to invest. You're gonna create multiple products to invest a specific amount to reach a target amount, and the time is the value of the process. So the value of the variable thing, the value of the process is the time. I give 10 millions, I want that 10 millions to be 15 millions. Give me the shortest time. You create multiple products and give me the shortest time. So a person or a company cannot ask a financial institution to invest a specific amount of money, like $1 million, to reach a target like 4.5 million. The financial institution set a plan and multiple products to reach the target in the shortest time and lowest available risk. Risk is to avoid reinvestment when loss occurs. So it is the lowest risk with shortest time, because I can't guarantee 4,500,000. When I say 4,500,000, I'll give you a risk percentage with a 20% risk. So we can reach, by $1 million, we can reach 4,500,000 in 2 years with 20% risk, with 25% risk. When risk occurs, I need to reschedule and report that the plan is changed to the customer. So make the share price fixed all time. This is the idea, is my share price is $1. All time is $1. What is variable is the number of shares. The fund start using a fixed price share and extended yearly principal policy. The shareholders can earn or lose shares every year. The fund has a fixed price per share all time. For example, $1 per share. At it started with a principle, for example, 1 billion US dollar, making a billion share. Each year, it is extended the principle by 10%, which is 100 million US dollar and 100 million share. So what we are trying to do here is creating a fair fund. We assuming that at the start of the fund, the price is 1 share. The price of 1 share is $1. When you try to join the fund, it is not fair to join the fund at the price of $10. So we're making that price as 1 all the times. If you are joining the fund from the first year, you earn share and you can do whatever you want with those shares. Sell them, keep them, but the price of that fund is $1 all the time. You might lose share if the fund is losing. You might earn share if the fund is making money and making profit. So to make it fair, you can join whenever you want at the same price. Distribute any remaining to shareholder. So every year, distribute any remaining to shareholders and send the non-divisible to invest to a target company. That's why we have the problem. So we have non-divisible to invest to a target company. So when we have cents, that aren't divisible to the, we give it to the company to invest it to a target. So we every year, it's like every year for this fund, end of the company, and we distribute everything to the shareholders. So each year distribute any remaining to shareholders as if it's a closing business or end of the fund. Any fraction that is not divisible per unit must be invested in a partner that over invest to a target price with a reference to reference to be tracked by shareholders. So it is we have this policy if the share price is over 1 cent, because if the share price is less than a cent, is more than a cent, if the share price is $1, it is not a cent, we should invest the remaining the extra money in one company that give us the target date of the distribution or dividend. So we are now in 2024 and we have those shareholders. We're gonna close that fund at 2024. The remaining is giving to our partner that gonna invest to a target date, and we close that. We increase the principal of the fund. We increase the market cap by 10% every year. That's the policy, increase every year by 10% or 5%. So the 1 billion share become 1,100 million or 1,050 million each year, and we close the fund each year, distributing everything to the shareholders. Customize available products in the market to create the shortest time to the target and lowest risk. Create a product that is tailored as the shortest time and lowest risks to reach the target amount from a starting amount from many available products in the market. So you can utilize zero risk products, low risk products, medium risk products, high level of risk products, short and long products. But you try to keep it shorter. So you try to give the shortest time. How can we implement a fixed unit price fund? A fixed unit, you start with a fixed unit. Distribution of earning. Every year, distribute the distribution of earning. Invest the fraction. Invest the fraction each year to fulfill each year distribution policy. Start new year as a new. Start the new year as a new fund or a new company with a new extra principal at 5 or 10 available for new buyers or old shareholders. How can we enhance this product over the time? We can create nested fund. 5 to 25% of that fund can be with a variable price for some people who having that preference, seeing the value of the price. And it can be also in indicators. A price indicator, an indicator shows the value of the investment per share or unit daily. So we know that each fund has two different values: the trading value, the price, the trading price at the stock market, and the net asset value. The net asset value, the value of the assets that owned by the fund for each unit or each share. So we can create such indicator.